Hello and welcome back to the Geordie Pig Investor channel. Today we have got a stock analysis video on United Parcel Service, stock ticker UPS. Is the stock a buy right now? What is United Parcel Service? United Parcel Service is a global package delivery and supply chain management company headquartered in Atlanta, Georgia. It operates in over 220 countries by offering services such as express shipping, freight transportation, and logistics solutions. UPS is integral to the functioning of the global economy, helping businesses move products efficiently and offering services that range from small packages to large freight shipments. It's also a critical part of global e-commerce infrastructure, ensuring timely deliveries to consumers worldwide. Some key stats about UPS: they are based obviously over in the United States. They are part of the industrial industry, have a market cap of $95.5 billion. They went public back in 1999, have over 500,000 employees. But to look at some of the more important stats, we can see they have a massive 15-year dividend growth streak. They have a 5-year dividend growth rate of 11.17% with a massive dividend yield currently sitting at 5.82%. Over the last 12 months, we can see that UPS is actually down 19.51%. And in today's video, we are going to have a look to see if the stock is a buy, hold, or sell. United Parcel Services earnings call and fundamental analysis. In the final quarter of 2024, UPS experienced a 1.5% revenue increase to $25.3 billion and an 11.2% rise in operating profit. The company is implementing a major efficiency initiative aimed to save over £1 billion and reconfiguring its US network. UPS is shifting focus towards SMBs and healthcare markets, targeting a 32% share of US volume in the SMB segment by the end of 2025. However, 2025 revenues are projected to decline by 2.3%, and they have offered weak guidance for 2025. Furthermore, my biggest concern is their decision to reduce its business with Amazon, as they are cutting shipping volume by 50% in 2026, as Amazon look to shift towards building its own logistic network to reduce reliance on third-party carriers like UPS. There is also concern around labour strikes over pay that can really disrupt the service. Having a little look at their fundamental analysis, we can see they have a positive free cash flow, currently sitting at $6.2 billion, exceptional 3-year average ROE at 63%. They have a positive operating income at $8.5 billion, positive gross profit sitting at $73.1 billion, positive net income at $5.8 billion. Very good long and short-term solvency. They have a high Altman Z-score at 3.29, have average debt to equity at 1.16, decent revenue growth forecast at around 5%, but they do have positive net debt currently sitting at $13.1 billion. Next up, we're going to have a closer look at UPS's free cash flow. Free cash flow is the money a company has left over after it pays for all of its expenses and any investments it needs to make to keep the company running smoothly. Free cash flow has a massive impact on what direction a company may be heading. From the graph, we can see that UPS has demonstrated strong free cash flow over the past few years, which is an important indicator of the company's ability to generate cash after accounting for capital expenditures. FCF is often used by investors to assess financial health of a business and its ability to return capital to shareholders through dividends, stock repurchases, or reinvestment into the business. However, UPS do have a high payout ratio, currently sitting at 87%, and while a high payout ratio can indicate strong commitment to returning value to shareholders, it may also suggest limited retained earnings for reinvestment into the business. UPS has expressed its dedication to sustaining its dividend payment even in the face of projected tight earnings coverage in 2025. Next up, we're going to get our first valuation, and that is from the discounted cash flow valuation method. The DCF is a method of estimating the current value of a company based on projected future cash flows adjusted for the time value of money. The DCF valuation process calculates the present value of a company's forecasted cash flow based on selected operating models. Right now, UPS is currently at $112, and when plugging in my discounted rate at 8.3% with a terminal growth rate negative 3.1%, we can see that UPS is actually worth $96.27. When using a discounted rate at 7.9% with a terminal growth rate at 0%, they were worth $146.80. And when we put in a discounted rate at 7.5% with a terminal growth rate at plus 3.1%, we can see UPS were actually valued at $282.40. I not only look at the DCF valuation, but we also look at something called the relative valuation. This is a method used to value a company by comparing it to other competitors based on certain metrics. The metrics it uses includes EV to revenue, EV to EBITDA, and PE ratios. Having a look at UPS on my worst case scenario, they were valued at $164.04, on the base case being worth $177.37, and on the best case being worth $194.52. From these, we can then come up with something called the intrinsic value. When valuing a stock and by combining the relative valuation with the DCF valuation, it will calculate the intrinsic value. So this is simply done by adding the two together and then dividing by 2. My worst case scenario for their intrinsic value was $130.16, average case being worth $162.10, and on the best case being worth $238.46. Finally, the last valuation method I do when looking at a stock is the Wall Street estimates. Wall Street estimates are an average estimate of a public company's quarterly earnings and revenues that lead to a valuation of that company. These numbers are forecasted by a company-specific analyst who provides research on that particular company and therefore comes with what they believe is an accurate valuation. There are multiple analysts for large cap companies, so a company like UPS is going to have lots of analysts checking the company out on a daily basis to come up with these valuations, hence why I like to use them. On the worst case, they believe UPS over the next 12 months could be worth $101, which is a 10% downside on the current price. They believed on an average case would be worth $151.36, which is a 35% upside on that current price. And on the best case, they believed it would be worth $187.95, which is a 68% upside on that current price. Now that we have all of our valuation methods, what I'll do is combine the three valuations together and get my final best, average, and worst case scenarios and see if UPS is at an attractive price. So on the worst case, when adding the three together, it was worth $120.44. So with a 10% margin of safety on the worst case price, I would be looking to buy UPS at around $108.40. And with a 20% margin of safety on the worst case price, I'd be looking to buy them at $96.36. On the average case, they were worth $158.51. So with a 10% margin of safety on this price, you'd be looking to buy $142.66. And with a 20% margin of safety on the average case price, you'd be looking to buy them at $126.81. And then on that best case price, we can see they were valued at $221.62, meaning with a 10% margin of safety, you could be looking to buy this stock at around $199.46. And with a 20% margin of safety, you'd be looking to buy them at $177.30. What does this mean for UPS? Is the stock a buy right now? In summary, UPS stock is down due to a combination of factors. These include their weaker than expected guidance, significant changes to its relationship with Amazon, rising competition, labour concerns, and broader market conditions. Having said this though, UPS stock is generally considered a solid investment for those looking to gain exposure to the logistics and transportation sectors. The company has a long-standing track record of stability, strong market presence, and steady cash flow. With its dominant role in the global supply chain, e-commerce logistics, and freight services, UPS is well positioned to benefit from the growth in online shopping and increased demand for fast, reliable delivery service. Additionally, UPS has a consistent history of paying increasing dividends for the past 15 years at a very healthy rate, having a 5-year dividend CAGR sitting at over 12%. Not only this, but they currently have a 5.8% yield, and even based on my average case price with a 20% margin of safety, this stock is very much underpriced. So for income-seeking investors, it could be one to add into the portfolio. Their ongoing investments in technology, sustainability, and infrastructure ensure they remain competitive and capable of adapting to the evolving demands of the logistic market. For long-term investors, UPS offers potential for capital appreciation, steady returns, and exposure to an essential part of the global economy. I hope you enjoyed today's video. Please let me know of any of the stocks you want to see a full breakdown on. If you're building a portfolio for passive income and financial freedom, don't forget to like, subscribe, and hit the bell notification so you never miss an update. Until next time, keep compounding and stay patient in the market because your future self will thank you. For now, this is the Geordie Pig Investor, over and out.